Today, we're taking a close look at Guangdong Gases, a company that currently presents a fascinating paradox for the market. On one hand, you have strong top-line growth. On the other, profits are falling. In this analysis, we're going to deconstruct the factors driving this apparent contradiction.
So, this is the central question we need to answer. Financial reports are showing some very healthy revenue expansion, but the bottom line, well, it's moving in the complete opposite direction. It's this disconnect that makes Guangdong Gases such a compelling case for a deeper analysis.
Now, before we dive into the specifics, let's start with our key findings. Our analysis points to three core takeaways. First, a cyclical downturn in the helium market is effectively masking the real strength of its core operations. Second, the company stands as a key strategic asset in China's push for semiconductor self-sufficiency. And third, its valuation seems to incorporate what we call a strategic option value on emerging technologies.
We've structured this breakdown into 5 parts. We'll begin with that core contradiction, then we'll decode the financial performance, examine the core business engine, explore its value as a strategic technology asset, and finally, we'll assess the key drivers and risks looking forward.
All right, let's get right into it and start by deconstructing that headline contradiction. What appears to be pressure on the surface versus the underlying strength of the business.
So at first glance, the growth story here looks quite strong. For 2024, the company posted a robust 14.6% increase in top-line revenue. This suggests healthy demand and a successful expansion of its business.
But here is the paradox. Over that exact same period, net profit fell by a significant 22.4%. You've got growing sales, but shrinking profits. This is the puzzle the market is grappling with. How can both of these things be true at the same time?
Well, the answer really lies in the profit mix. When we unpack the sources, the picture becomes much clearer. The core, non-helium part of the business actually saw its gross profit surge by an impressive 34%. But, in contrast, the much smaller helium segment experienced a 79% collapse in gross profit. This was driven by a sharp drop in global helium prices. So this cyclical downturn in what is a relatively minor segment completely masked the powerful growth of the company's main engine.
Now, to build a more complete financial picture, we need to go a layer deeper. We can systematically understand these dynamics using the DuPont analysis framework, which breaks down return on equity into its core components.
This table tells a very clear story. You can see return on equity, or ROE, fell dramatically from over 15% in 2023 to under 4% more recently. The DuPont framework shows us exactly why. A sharp drop in the net profit margin, which we've already traced to the helium price issue, a decline in asset turnover, and a reduction in financial leverage. This is really a multifaceted decline.
So here's the crucial point. The drop in ROE was caused by 3 distinct factors hitting all at once. Profitability took a hit from the helium cycle. Asset efficiency was temporarily diluted because the company made huge investments in new projects with funds from its IPO. These are assets that are now on the books but aren't generating revenue just yet. And finally, that same IPO expanded the equity base, which naturally reduces financial leverage. All of this suggests the current low ROE is a temporary state, not a sign of a broken business model.
With that financial context established, let's turn our attention to the core business engine. This is deeply tied to the national strategy of what's known as semiconductor domestic substitution.
The company's main products are what we call electronic bulk gases. Now, these aren't just any gases. They are ultra-high purity substances absolutely essential for manufacturing semiconductors. We're talking about purity levels measured in parts per billion. Guangdong's Super N technology was a genuine breakthrough, allowing it to compete head-to-head with the international giants that had monopolized this market in China for decades.
And this number right here demonstrates the success of that strategy. In 2024, Guangdong Gases captured 41% of all new on-site gas projects for chip makers in mainland China. Achieving the #1 market position this quickly is a very clear signal that the domestic substitution policy is translating directly into market dominance. And this helps explain the valuation paradox. It seems the market isn't viewing Guangdong Gases as a traditional industrial gas supplier, which typically has lower growth and lower valuation multiples. Instead, it's being priced as a semiconductor materials asset, a high-growth company that's aligned with a national strategic priority, which naturally commands a significant valuation premium.
But the story doesn't stop with semiconductors. The analysis suggests we really need to look even further into the future to understand this company's full strategic value.
So we have to ask the question, is this company simply a supplier for the current semiconductor cycle? The data suggests the answer is no, and that looking beyond the present is absolutely key to understanding its valuation.
This table is crucial. It shows that the very same gases Guanggang specializes in are not just important, but often irreplaceable for next-generation technologies like quantum computing and controlled nuclear fusion. For example, helium-4 is essential for cooling superconducting magnets in both of those fields, and the extremely rare isotope helium-3 is the irreplaceable working fluid for the dilution refrigerators that sit at the very heart of many quantum computers.
This quote summarizes the point perfectly. The valuation reflects what's known as a strategic option value. Essentially, investors are pricing in the possibility that Guanggang will become the key supplier for these future, strategically vital industries. It represents a call option on the entire future tech ecosystem.
Now let's look ahead and balance this potential with the concrete drivers and the significant risks that will really define the path forward for the company. Our analysis identifies three primary growth drivers. First, there are powerful policy tailwinds, like China's massive Big Fund 3 for semiconductors, which will continue to fuel demand. Second, the global semiconductor industry is widely expected to enter an upswing starting in 2025. And third, the company has a large backlog of contracted projects that will begin generating revenue over the next few years, providing very clear built-in growth.
Of course, a balanced view requires looking at the risks, and there are significant ones. Market risk remains, both from the cyclical nature of semiconductors and the continued volatility of helium prices. Operationally, executing on its many large-scale projects carries the risk of delays or cost overruns. Competition from the established global players is, and will remain, fierce. And finally, because the company's success is so tied to policy, any shift in national strategy could pose a risk.
And this leaves us with the ultimate question. The company is facing a clear conflict: powerful short-term headwinds from the helium market and heavy investment versus significant long-term tailwinds from national strategy and future technology. Which of these two powerful competing narratives will ultimately define the future of Guanggang Gases? That, right there, is the core of the valuation paradox.